In the words of Jerome Powell, digital currencies will need new regulations. The head of the Federal Reserve, Jerome Powell, has stated that cryptocurrencies and stablecoins, among other forms of digital currency, pose threats to the U.S. financial system and necessitate additional regulations to safeguard consumers. Even though Powell pointed out that technological advancements are anticipated to reduce transaction costs and speed up processing times for online purchases, he further explained that they pose a threat to the stability of the current financial system. So why does the Fed want crypto regulation? And what does this mean for investors? Welcome back to Bitcoin Broadcast, one of the best channels for the latest trending cryptocurrency news. If you seek to be updated on what is currently happening in and out of the crypto world, this is the place to be. Without further ado, let's get started. In 2022, the global markets have been severely damaged as a result of a variety of different events. Fear of war, inflation, global warming, and several other issues that are not connected to one another have contributed to a dramatic decline in the economy of many different nations. As the situation has become increasingly dire, countries have been working to diligently find solutions that would prevent any possible disasters. Since the beginning of the epidemic, the United States, along with many other nations, has been one of those that has been one of the most economically devastated and has been struggling. There's no question that this has had a very negative effect on the market for cryptocurrencies as a result of its effects. These pessimistic outlooks, which permeate the entirety of the investment industry, have had a huge detrimental effect on the sector. It has been demonstrated throughout history that whenever the nation's top financial institutions take significant choices or actions, the market for cryptocurrencies is similarly and significantly impacted. The volatility of markets on a global scale has been exacerbated as a result of several key decisions that have been taken amid ongoing discussions and debates about the future of the economy. The most recent speech by Jerome Powell has received a lot of attention and is credited with being the reason for big market swings, which have been trending in the other way. Jerome Hayden Powell is now serving as the 16th chairman of the Federal Reserve. Having served for a considerable amount of time in a position that required a great deal of responsibility, has in the past made some important decisions that have had a substantial influence. During the time of the pandemic, he was praised for the adept way in which he handled the nation's financial condition. And now, while addressing the annual policy event held in Wyoming by the Kansas City Federal Reserve, the chair of the Federal Reserve emphasized the implications that were being caused by the global markets. His evaluation of the state of the nation's finances at the time led him to the conclusion that important actions were required to be made in order to protect the economy. Since it was a speech that had been widely anticipated and that would have a substantial influence on the markets, Powell opted to take a direct approach. He offered a hint that, in addition to the primary aim of controlling inflation, there may be another hike in interest rates in the future. Moreover, he voiced his concerns about a large number of households and businesses that would be the most adversely affected by the impending changes. Because an increase in the interest rate will also result in looser conditions in the job market, the economic security of those who are employed and tied to the economy will be in jeopardy. However, he further stated that it's necessary to go through this pain in order to put a stop to any more bleeding that may occur in the future. The 8-minute speech resulted in an overall decrease of more than $78 billion in net worth for several billionaires. A significant loss had also been noted in the stock market, with the S&P plummeting by around 3.4%. Even if all these parties were ready for a more immediate financial crisis situation, the value of certain well-known businesses nonetheless went down slightly. According to Powell, investors should be wary of the risks associated with investing in assets and be more frugal now than they were in the past, since there will be changes that have the potential to harm the financial well-being of many citizens. In essence, the United States government is just continuing to create more foundations for potential cryptocurrency regulation in the future. In a hearing that was given in July before the Banking Committee of the United States Senate, Federal Reserve Chairman Jerome Powell emphasized the Fed's interest in regulating stablecoins and the possibility of the central bank issuing its own digital currency. Powell compared stablecoins to deposits in banks or funds that invest in money markets, both of which are subject to stringent supervision in the US. On the other hand, he said that stablecoins don't have the characteristic. and if that they're going to play a significant part in the payments ecosystem, which he still doesn't believe crypto assets will, then they'll require an appropriate regulatory framework, which, to tell you the truth, the US doesn't have. Many cryptocurrency experts agree that long-term investors should stick to investing in identifiable currencies such as Bitcoin and Ethereum. The two currencies that are used the most are often the best options for most people unless you engage in more active trading and are ready to take on the risks of acquiring lesser-known coins. Stablecoins and other smaller altcoins are more likely to be influenced by regulations of the type Powell is discussing. Mike Welline, the founder of Wealth U Advisors and a financial advisor, observes that cryptocurrencies like Bitcoin and stablecoins each have their own unique applications when compared to one another. Bitcoin, which he describes as digital gold, is more similar to the current monetary system than stablecoins, which have an unlimited supply and are centralized. Bitcoin is more suited to holding potential worth than stablecoins, which are better suited for digital transactions and converting digital assets into and out of real money. There are a few key distinctions to keep in mind when comparing investors who purchase Bitcoin as a store of value to investors who purchase stablecoins as a store of value. Competition for stablecoins might come from digital currencies supported by a central bank, but not from cryptocurrencies like Bitcoin. However, any newly enacted legislation could influence their investment portfolio. Even though decentralized cryptocurrencies like Bitcoin, which are managed by users all over the world, may not be directly impacted by stablecoin legislation or a CBDC, it is possible that regulation may lead to increased market volatility. Already, a portion of the recent drop in the price of Bitcoin to $30,000 has been ascribed, at least in part, to the Chinese government crackdowns on cryptocurrency regulation. We have also observed that the values of other currencies tend to follow one another. For instance, when the price of Bitcoin drops, the price of altcoins tends to drop. There's also a possibility that regulation may render many of the currently available cryptocurrencies unusable. On the other hand, in comparison to Bitcoin, the restrictions that Powell outlined are likely to have a far higher impact on the value of stablecoins or smaller altcoins. The time has come for regulatory examination of stablecoins, decentralized finance, and other matters. And that's a wrap. What do you think about the regulation of cryptocurrencies? Will it be beneficial to cryptocurrency investors? Comment below. Let's interact. Also, please leave a like and subscribe, and don't forget to turn on the notification bell for more amazing cryptocurrency news.